It started with a number on a screen that made no sense. Silver was calm, almost boring, barely moving on the spot market, and yet coin shops across America were selling out before noon. Prices online said one thing, but in the real world, people were paying something completely different. That was the day physical silver disconnected from the spot price. And if you were watching closely, you could feel the shift in real time. Something inside the system was straining. Welcome to The Monetary Shift, where we break down the hidden moves behind money and markets. If you want clear stories about how the financial system really works, make sure you like this video and subscribe within the first minute so you never miss what happens next. On paper, silver looked stable. The spot price barely moved, hovering quietly as if nothing unusual was happening. But inside coin shops, bullion websites, and private dealer networks, the story was very different. Premiums were exploding. For anyone new to this, the spot price is the price you see on financial screens. It is based on futures contracts and large-scale trading, not on someone walking into a store to buy a silver coin. Physical silver is the actual metal in your hand. Coins, bars, and rounds that have to be mined, refined, shipped, and stocked. Most of the time, the difference between spot and physical is small. A few dollars extra, maybe a modest premium for minting and distribution. But on that day, the gap widened fast. Dealers began adding $5, $10, even $15 above spot for a single ounce. Online inventories turned red with out-of-stock warnings. Delivery times stretched from days to weeks. So what happened? Why would the screen say silver is cheap while real buyers were paying far more? It began with uncertainty. Economic headlines were flashing mixed signals about inflation, interest rates, and banking stability. Some investors lost trust in paper promises. They did not want exposure to contracts or exchange-traded products anymore. They wanted metal they could hold, metal outside the system. As fear spreads, demand for physical assets can spike quickly. But the supply chain for physical silver is not instant. Mines cannot double production overnight. Refineries cannot magically increase output in a weekend. Mints have limited capacity. Shipping and logistics take time. Meanwhile, futures markets can trade enormous volumes of silver contracts with just a few clicks. Most of those contracts never result in delivery. That is where the disconnect begins. The spot price reflects paper silver, traded in huge quantities that may represent many times the amount of real metal available. When confidence in that paper structure weakens, physical demand surges, but the spot price does not immediately reflect that surge. Instead, premiums absorb the shock. The gap between paper and physical grows wider. Imagine two parallel worlds. In one world, traders are flipping contracts back and forth, focused on charts and short-term moves. In the other world, families are lining up at coin shops, paying cash, and clearing out shelves. Those two worlds do not always move together. On that day, they clearly did not. And that is when people started asking a deeper question. Is the spot price really the true price of silver, or is it just the price of a promise? For decades, the system worked because most participants trusted it. Futures markets were liquid, efficient, and rarely challenged. But trust is fragile. Once it cracks, behavior changes fast. Dealers noticed something unusual. Customers were not just buying a few ounces. They were buying tubes, monster boxes, entire cases. They were asking about delivery guarantees. Some even asked to inspect inventory in person. That kind of behavior signals fear. Fear does not show up neatly on a price chart. It shows up in premiums, in shortages, and in empty shelves. And then social media amplified the moment. Posts and videos spread stories of local shortages. Suddenly, people who had never considered owning silver felt the urge to act. They did not want to be the last ones in line. As orders piled up, dealers had to protect themselves. They raised premiums not only because demand was high, but because replacing inventory became uncertain. If a dealer sells out today and cannot restock at yesterday's cost, they risk losing money. So they price in that risk. This is how physical markets send signals that paper markets sometimes ignore. Premiums become a pressure valve. Meanwhile, on trading screens, algorithms kept operating as usual. Large funds adjusted positions based on macro data and technical indicators. But they were not standing in line at a coin shop. They were not seeing empty cases. This divergence creates tension. If it continues long enough, one side must adjust. Either physical demand cools down and premiums fall back toward normal, or the spot price eventually moves to reflect the tighter real-world supply. On that day, the disconnect felt symbolic. It was not just about silver, it was about confidence in the broader monetary system. It was about the difference between digital entries and tangible assets. For many viewers of the monetary shift, this moment felt like a wake-up call. It forced a simple but powerful question. What do you actually own, a contract or a commodity? As days passed, some premiums eased, others stayed elevated longer than expected. That persistence suggested the issue was not purely emotional. There were structural limits in refining and distribution. The silver market is relatively small compared to stocks or bonds. A sudden wave of retail demand can have an outsized effect. And when institutions are not demanding delivery at the same time, the paper price may lag behind reality. That lag creates opportunity and risk. Some traders tried to exploit the gap. They bought physical and hedged with futures, hoping the spread would close. Others avoided the complexity and simply paid the premium, believing long-term it would not matter. Their focus was preservation, not short-term profit. The deeper lesson was about liquidity. Paper markets are extremely liquid until they are not. Physical markets are slower, but in moments of stress, they reveal where true scarcity lies. Scarcity changes behavior. When people sense scarcity, they move quickly. They stop negotiating over small price differences. They prioritize access over perfection. That shift in mindset is powerful. It can spread beyond one metal. It can influence gold, commodities, even currencies. And it reminds us that markets are not just math. They are psychology, layered on top of supply chains. The day physical silver disconnected from the spot price was not a collapse. It was a warning signal. It showed how quickly confidence can fracture. It showed how two pricing systems can drift apart. If you were watching carefully, you saw more than a premium spike. You saw a glimpse of how fragile pricing mechanisms can be under stress. For long-term investors, the event reinforced the importance of understanding what drives price, not just headlines, but structure. For new buyers, it was a lesson in patience and timing. Premiums can rise fast, but they can also normalize. As we look ahead, the key question remains, will physical demand continue to challenge the paper market? Or will trust in futures pricing remain strong enough to keep the system aligned? That tension is ongoing. At the Monetary Shift, we believe these moments matter because they reveal how money truly functions under pressure. They show us the cracks before they become breaks. Now, I want to hear from you. Do you think the spot price still reflects reality, or is physical demand rewriting the rules? Drop your thoughts in the comments below and share this video with someone who follows the silver market. Conversations like this help more people understand what is really happening beneath the surface. If this breakdown helped you see the market differently, make sure you are subscribed so you do not miss the next shift. Because in a world of digital numbers, sometimes the real story is found in what you can actually hold.